Hey everyone, welcome back to Red Panda Investing. And today we're going to talk about a company that I really didn't expect to do analysis on anytime soon. But I did decide, you know what? Let's just have some fun with it. Let's look at a company that not many people are looking at. I don't know how it's gonna turn out, but I figured I might as well just practice on a company that's not one of the Magnificent Seven. And that company here is Cat or Caterpillar. So what is Cat? Caterpillar, right, is a heavy equipment manufacturer. So think of the big trucks and bulldozers that all little boys and little kids are actually enjoy playing with as a child. That they make that, and then in addition to that, right, they use industrial support to support the machines they make, energy transportation, and financing for everything that they sell. Because obviously, buying a bulldozer, buying a a big truck, right, a dump truck, is not going to be super economical to be able to pay all in cash. You're going to have to do financing with that. So that's what they are, right? What about headwinds and tailwinds? Uh, this is actually going to be something that is going to be somewhat important, especially for Caterpillar, because they are much more of a cyclical company. Some big headwinds here, right? Global GDP has been slowing with inflation picking up, with a lot of governments really spending a lot. That actually could be a tailwind, right? Infrastructure spending. But we do see here in the United States, at the very least, that the economy is slowing down, and tariffs are going to be something that hurts Caterpillar, not as much as some other companies, but it does hurt them in the sense that the machines that they build are going to have tariffs on top of the raw materials. They're a highly skilled company. They also are in an environment with a lot of competition, right? If you think about heavy machines like John Deere also makes some. There's a couple other ones, but I just don't remember them off the top of my head. Tailwinds, right? Like I said, currency fluctuations could be a tailwind, could be a headwind. Right now, I'm seeing it more as a tailwind because USD is depreciating, which means that some company like Caterpillar that is based in the United States is going to be able to sell their big machines at a relatively cheaper price abroad. They do also allegedly have a high backlog. Not sure how big of a backlog it is because we'll see what their earnings and what their revenue and margins are looking like. And I'm not sure if that high backlog is actually helping them right now. In addition, they are moving towards more of the after purchase services, so things such as maintenance or things like software updates. They're moving towards that, which means that their revenue income isn't going to be based solely off of the cyclical buying and selling of industrial machines, and they can actually have a larger margin base uh, item that actually isn't as cyclical because you're always going to have to do maintenance on your trucks even if you've bought them like 5, doesn't matter if you bought them 1 year ago or 10 years ago. But, right. So revenue and profit history. This we'll see that I actually put a much longer time span on for Caterpillar than what I've put for the previous few companies that we've been looking at. Part of that is being we know that Caterpillar is a cyclical company, right? So you can see these ups and downs within the history of Caterpillar and its earnings and its growth, right? The 10-year median growth is actually negative 16%. The 5-year CAGR is 17%. So it's been growing revenue, right? Probably with the backlog and with the services, but the median hasn't really been great, right? You see these ups and downs. The earnings as well follow the same up and down cycle with a bit more exaggerate. However, the earnings are a bit more exaggerated. The reason for that, once again, as we always say, coming back to the margins. The margins are actually currently at 15%. They've been expanding recently because of their services. However, the 10-year median PE and 10-year average PE are both set at a 16. Uh, I don't know why I said however there because I meant however the margins have been shrinking recently, and due to the fact that I do see a recession in the future. I'm hard pressed to actually say what I would that the margins are going to expand, right? I really do see margins actually contracting for such a company. So let's actually let's take a look here, right? What do I expect here? Well, revenue has been turning over recently, right? They are cyclical. I do expect a recession sometime soon. So next 5 years, I don't really see much growth for the company. Profit margins are going to be contracting, I think, once again, due to recessionary fears, does mean that NDP is going to be at 6 instead of the historical 16 because of the lower growth rate of the company. This would actually mean that it has intrinsic price, at least to me, 40, like just a bit under $50, which is ridiculous considering what type of company it is. And obviously, this does put into question, okay, is my type of analysis valid for a company like this? Free cash flow analysis, once again, long time span, minus 16% 10-year median, 17% 5-year CAGR, and price to free cash flow is actually identical to essentially the PE, meaning that the earnings and the free cash flow are very similar, right? So that median of whatever I said, 16 and 16. Once again, I am going to assume the free cash flow is going to be growth is going to be slower, right? It's going to be at what 1% over the next 5 years. I don't see them actually having no growth. Just going to be harder for them to have growth. Which gives them a PE of about price of free cash flow about 7. The issue really for Caterpillar more than anything is that they have $87 a share per share of debt, right? So that also is taken out of how much revenue is considered from the company. So you see at the bottom, we have all this added up. The total discounted value, you have to subtract the 87 out of it, which does take us down to just under $40 per share. Dividend analysis. This is probably the first company where dividends actually make sense to now analyze off of because they've had a long track record of having dividend growth. And if you are buying a company such as Caterpillar, you are looking at this dividend growth and you're trying to rely on this dividend as to supply you with cash coming in. Right? So if we take a look at it, they've had it's about a 25-cent increase every year. Currently it's at an 8% growth. The way I have it set up is it's difficult for me to put a raw number in there. It's easier for me to just put the formula for the growth percentage. So I just did it that way, assuming about a 6% growth rate, ending yield at 4%. What we see here is once again, it gives it a price of just under $70 here. So altogether, is my process of evaluating this company correct? I probably would say because of my required rate of growth at 15%, it's probably not a great way to evaluate companies such as Caterpillar, which is involved in such industrials, which is at a mature phase. And really, when you buy it, you are looking at that dividend and dividend growth rate more so than you're looking for rapid accumulation of dollars per share. How much you're not really looking for that price appreciation. That being said, right, I have to actually say something here. I did mistype this. That should not say hold. That should absolutely say sell. But because looking at this, right, a revenue at 47, a free cash flow value at 40, right, and a dividend at about 68, I would put more emphasis on dividend here simply because that's probably what most people are looking for. But once again, my process probably isn't that valid for a company like Caterpillar, right? So the rating is sell, not hold. At least that would be for me. If I currently have the company, I would definitely just get rid of it because it doesn't fall into the type of companies I want to hold and the type of returns I'm looking to get from investing. Thank you very much. Let me know if there's any improvements I can make. Please leave a like and subscribe and let me know what other companies you guys would love to see me analyze. Thank you so much.